Hi everyone, welcome back to the channel. My name is Juan. I'm with Katy Wealth Builders, and today we're gonna talk about Brandon Turner, one of the most well-known real estate investor. He started his career out as a podcaster for BiggerPockets, the website, a real estate investment platform. And then after that, he went out and he opened up his company called Open Door Capital to syndicate multifamily. Recently, they went public with a major multifamily syndication deal in Katy, Texas that collapsed, resulting in a $15 million loss from the limited partners capital. And if you do a quick search on Brandon Turner $15 million, you'll see a whole bunch of video within the last few weeks about his $15 million loss and the collapse of the deal. And then in this video, I'm gonna go through what I think went wrong of that deal. So let's get started. So the first thing that I believe what started out the whole chain of event is that the market timing and the high price purchase price that they did. The property was acquired at the peak of the multifamily cycle. They purchased the property at $72 million, and to win the deal in a hyper competitive environment, I think this is back in December 2021. The team bought the property at a very aggressive 3% capitalization rate. Buying at a low cap rate leave virtually very little room for error when the market shift. So how you calculate the cap rate of property? An annual net income. You take the annual net income and you divide by the property value and you get the cap rate. So for this example here, as you can see, you have a $600,000 net operating income, and you purchase the property assuming that at $14 million, then the cap rate is 4.3%. So if the cap rate is lower, like 3%, then you just take a 600,000, sorry, you take 600,000, right? And you divide it by the cap rate of 3%, you get 20 million. So for a property like this, they probably purchased for 20 million if they're using a 3% cap rate of the property that generates 600,000 in income, right? So because of that, the lower the cap rate, the higher the price. Typically for investor like me, I usually come in as a note like average cap rate of at least like 6% or more. So if it's a 6% cap rate, I think that's leave me enough room for me to be able to to navigate with uncertainty that come up later on, like any major repairs that is unexpected. You can use the cash flow to be able to kind of service that request and still have a decent return, right? So because they went in with a 6 to 3% cap rate, they already purchased at a really high price, right? So that's the first thing that happened with the property. The second thing that I believe add fuel to the fire is the variable floating rate debt. This number 2 and 3, it's actually like go hands in hand. The first thing is about the deal was structured using a massive short-term floating commercial loan of roughly 52 million. In syndication, variable debt is common when executing a value-added strategy, but it's exposed the deal to a severe interest rate volatility. So the floating rate, how does it work? So usually it started out at a very low rate, and then like for this example, like a 3.5%, and then over time when it expire, it's gonna the rate is gonna when the rate readjusts, it's gonna add a the base plus the plus or minus the rate of the market. So it could go up, it could go down, but usually be depend on the market rate. If the market rate drop a lot, then it's going down because but then as you can see, like during this time after 2021, the rate actually is going up slowly, and this is the third it go toward the third not the third reason is because of the rapid interest rate increase by the Fed. So the Federal Reserve raised interest rate at one of the highest fastest pace in history because the refinancing was locked into a long-term fixed rate debt. The monthly debt service obligations skyrocketed and rapidly chewing through the property cash flow. If you live, if you remember, like during COVID, like I think in 2020 was the last time that we see like a record low interest rate of like a 2 or 3%. Right after COVID hit and then inflation went up, then the Fed, in order to fight inflation, they have to raise rate, and that's the reason why the rate went up since 2021. And when they purchased the property, they initially get the low rate, but then because over the years after that, the rate went up so much quick, so quick, they can't be able to refinance the property into a better term. As you can see here, like for this example, like you got a rate of like the new rate is 5% instead of like 3.5%. So that cost, if it's gonna 50% more in servicing costs for their property. So during that time. And then the fourth reason is because of the skyrocketing cost of the rate cap. So to protect against floating interest rate, lender require commercial borrower to purchase a rate cap, essentially in an insurance policy that limit how high the interest rate can go. These rate cap are short term. When Open Door Capital purchased initial rate cap expire, the cost to buy a new one is a high interest rate environment had ballooned from 10 of thousand to 100 or million of thousand, right? So this is how it works, so you purchase it so that you can cap it. So during that time that the rate is there's a set amount of time that's a set amount of how much the rate can increase during that time. And when it's expired, because the interest rate went up so much, the cost to purchase the rate cap went up as well. And that, of course, is going to have to come out from the operating income, and it's going to lower the income that they generated, even though they were able to maximize their occupancy rate, right? And then the last reason is because of the cap rate expansion and the plunging valuation. So as interest rate rose across the economy, cap rate naturally expanded. When cap rate go up, commercial property value go down. Even though the property was full and tenants were paying, the overall paper valuation of the building plummeted below the balance of the loan, eliminating the ability to successfully refinance out of the short-term debt. And so, as you can see, because the cap rate and the interest, because look, if the expansion, so how does the rate expansion work? It's like if it's increased, then it's gonna lower the value of the property, and then because it's low value of property, they can't refinance to a better, with a good value. As you can see, the exact value is here, and then the more rate and the more the cap rate increase, the lower. Now you remember that we did start out with a 3% cap rate. Let's see how that worked, right? So here, so this one is the assumption is like scenario number one is low cap rate, right? So as you can see, the net operating income for the property with a 3% cap rate at the value of 72 million, you come up the operating income is around 2.2 million a year, right? That's with the 3% cap rate. So assuming that at the end of it, you still operating income might increase a little bit. I don't know the exact number because they don't disclose it, but let's say it keep the same, but then you raised up the cap rate to 6%. Essentially, the property value is becoming only 36 million. Now, here's the big problem with the investment that they had. Remember, at the beginning, where we already disclosed that they borrow around 52 million, right? So if that their principal, their balance is 52 million, but then when they want to reset it, and then the cap rate of the of the property is supposed to be around 6%, the value of the property is only 36 million. It's not even enough to pay for the 52 million. So as you can see here, if you take $52 million and you subtract it by 36 million, you have roughly around $17 million left. Now that is essentially around the $15 million that they lost, that the investor got wiped out. So that's how, when the cap rate increase, the property value go down. The only way that you can keep the cap rate lower in this environment, if you can increase the operating income dramatically, which they kind of did, but they didn't increase it enough in order for them to refinance at a good term. Because they purchased a property at 72, they'll probably only value at 36 at the end of it, and they can't, no lender's gonna loan them the 52 to pay the old mortgage, and then roll it over to the new one because the increase in cap rate. So the outcome is the trap between expiring rate, ballooning interest expense, and the property value that no longer support the underlying debt. The team was forced to exit the property, completely erasing the $15 million in equity put up by passive investor. Right? So because they can't refinance to a better term, and then the increase in the loan services because of increase in the interest, and then the increase in the rate cap insurance, everything just happened at the same time, and they can't increase the income quick enough to be able to stabilize the investment, and they had to exit as a loss. Right? So Turner received notable credit in the real estate community for being completely transparent and taking public accountability for the losses rather than sweeping it under the rug. However, the deal served as a massive cautionary tale regarding over leverage and underestimating interest rate risk in commercial real estate. Right? So that's the reason why, if you watch my other video, you know that when I enter in a deal, I only have one kind of, like, I would call it a syndication, but it's like one deal that have investor money, and it's very low right now. Like I think if you go back and look at one of my other video, the 14 unit that I had, I actually only have like 30% of the money are investors. 70% is actually my capital, and since that's my first property that I kind of syndicated. I want to make sure that I know how to manage it before I move on to lower my portion, my ratio, and then increase the investor ratio. Now, my take is that when a deal is too good to be true, most of the time it's not. I don't promise my investor, like, I don't promise my investor, like, high return. I always tell them that, oh, this is what we're gonna get, and over time maybe we'll be able to get to here, but for now at the beginning this is where we are. Like, like a 5 or 10, like 6% return on your capital for the first few years, right? So, and then of course, when you invest with somebody, make sure that not all the money are coming from investor. If the GP, the general partner, have skin in the game, they will not walk away scot free. Like, they will lose something, and they're gonna underwrite it more carefully. For this deal itself, there are so many red flags, and I read online. I asked a couple of people online with this particular, like, deal, and a couple of them brought up like really interesting take, and they said that, even though, because from me, I know that Bain Turner is very well known in the real estate investment community, but I didn't realize that this might be one of the very early, like, big commercial deal of his. So I think this collab itself might be the first of many. So let's see how every other investment of his, commercial property of his, gonna turn out in the long run. But for now, this is very, very concerning. Anyway, if you see this any value in this video, and please hit the like button and subscribe to my channel so I can bring more content like this in the long term. Thank you so much, and see you next time.